Good morning, Scott Redler, T3 Live. Welcome to today's morning call, the Friday morning call, right in front of a nice weekend and right after Thanksgiving. Hopefully everyone enjoyed their family, had some nice turkey. I hope it was moist and crisp like a turkey should be. And hopefully everyone enjoyed their family and really thought about what they're thankful for. And now everyone's attention turns to the next holiday season, which are what do you want for the holidays? What do you desire? And unfortunately, over the course of the past decade, it's everyone's wants and desires which has been getting everyone in trouble because you've been getting what you wanted or desired on OPM. Any of you watch that movie back in the day, what that is other people's money. Okay, the world's been living on leverage and with the credit card that has basically been revoked now. And everyone's trying to figure out what to do because not a lot of people have cash, not a lot of people have savings. Countries don't have cash, don't have savings, and the ones that have been living on this excess leverage are getting it revoked or they have to pay dearly for it, and this push-pull is turning into what could be a very systemic situation as we move forward. So as that happens, as traders, we need to watch the technicals because a lot of people have been saying that this could happen for the last year or so, but if you didn't time it correctly, the question is, could you be short and could you stay solvent until you're correct? And if you look at the chart of the spiders, you will see that some people that thought that the world was going to end back on October 4th based on what was going on in Europe or overseas, they got trapped. All right, and at this point, technically, it turned into a very nice rally for those that trade technicals, but for those that fundamentally look at the overall world picture, the question was, can they stay short? Can they stay to their thesis? Then once we got into this wedge type pattern, and things started to really escalate, whether it was the Italian yields over 7, the Spain yields over 7, Greece losing their government, you name it, to that last auction that went off in Germany that was very unsuccessful, all of a sudden, technically, the world changed again once we broke below this 124.5, and since then, we've had about 7 down days. We've broken every basic retracement to indicate whether we're in a strong market, and now we're coming into one of our last points of reference, which is right around 115.06. So at this point, as an active trader, you have to be very quick and nimble because once that wedge broke to the downside, if you were carrying positions as a trend trader or momentum trader, you had to stop. Okay, and even if you got out correctly, it feels like last week I was trying to buy for an oversold bounce. Well, that wasn't last week; it was this week. It feels like last week, but Tuesday, Wednesday, and there was no bounce. So the question is today. Can they take the market positive? Maybe green just for the headlines to say, oh, market breaks at 7-day down streak, so all of a sudden everyone feels a little bit happier and spends through the weekend. But who knows? You can't trade with a thesis like that. But if you look at the level, watch the action, see if anything goes green, then maybe if you're trading today, you can make some cash flow. But overall, I think that the market has so much to prove, and for you to put anything more than just an intraday trade on, you must have a big risk tolerance. There are those that are trying to hold for macro trades, and they've been in all year, and if that's what you do, that's fine. But make sure that if you added tier 2 or tier 3, I think you went back to tier 1 already, and just trade intraday around other things if you have the time to do so. So once again, I'm going to try, not get stubborn, but even not getting stubborn, it's like death by 1,000 cuts. It hurt a little bit trying to be long a little bit, based on this chart. I tried on Wednesday right around here, and there was no bounce. So I will give it a little bit of time here or try on this down open, maybe it goes negative to positive, maybe you add through 116.56, and then we put a little bit of a reversal bar in here that might just relieve a little bit of the pressure, and then but I don't really foresee any kind of massive rally. I think if we were lucky, and I think it's almost lucky, you get a move back to retest this gap at some point, and then that might be a better spot to put some shorts on. But if you shorted this wedge and you've run the course and you didn't get stopped out, this would be an area short term to take some money off the table, I would assume, unless your thesis really is longer term and you feel like we could be down at these lows, which I don't rule out at this point. I don't know if it's going to be this year or it'll be next year, but we got some very systemic headlines, and at this point the market is a dangerous place, so know your risk tolerance. But something like today, I'm going to just focus on a few stocks. Apple, if you looked it off the charts, you will see it's coming into a crucial area. Was a nice short once it broke this 394 and broke the 50-day. Now it's coming into this 200-day. It did close on the lows, on Wednesday. It's opening up a little bit. If you long traded versus the low from Wednesday, 366, and then you have the low here, 365.91. This is a pretty crucial area, guys. Okay, this line that you're seeing right now underneath it is somewhat of a longer-term uptrend that Apple's been in for a heck of a long time. And if it starts to break and close below this, I would think, and especially below the 200-day of 363-ish, it could have a move down to this next point of reference, and that means this market's getting pretty damn ugly. So just know this level. This was your micro zone that we've been trading on a macro level. I think macro holders of Apple, you would have to take a look at this area and be a little concerned if that starts to break. As far as something like Amazon, I guess it's worth a look, but it's still, it didn't fill that gap. It was a little bit of a trap. I lost some money trying to buy it around 194 on Wednesday, turned tail. This is your new little pivot. I feel like all these stocks have new little pivots, and the question is, can you maneuver it, for cash flow? And if it doesn't work out, you have to realize it, because if it stays below this gap and hangs out in here for, the next few sessions, it's in jeopardy of breaking, to the downside. You saw after the earnings gap, it had a little bit of a move, gave some cash flow here and there, but overall, it never really bounced and filled the gap and bounced back the way Amazon bounces back, and then lo and behold, it resolved to the downside. As far as something like Google, it too is like grasping here. We had some nice trades. This was the earnings gap above that 602. Then all of a sudden it looked good up here while the market was in the wedge, and then when the market couldn't break to the upside, the best stocks get hit also. And now it's coming into this moving average. I think it's worth a look here. The low here is 570. Perhaps it goes from negative to positive, and we can make some cash flow. But overall, it's definitely losing its momentum as this gap is getting filled. But it's still above some moving average, so I'd say it's worth a look if you trade Google. This is a decent spot for cash flow, but just know if you're holding a longer term, it's not going to just buck the trend. Baidu, nothing really here except for last time it broke this wedge. You had a little bit two-day bounce to fill the gap that you had to be a surgeon and really quick, and now it's back in building a small pivot like most other things. But look at these moving averages, looking right above its head, big time resistance. It's not going anywhere to the upside anytime soon except for just a scalp. And you look over here, it's even bigger term support that if it were to stay here for a little bit, it looks like a better short than a long, unfortunately, or fortunately if you're a bear. As far as some of the banks, they've been the weakest sector. We've been using Goldman Sachs as a gauge. First we had 101 to 102, broke below that, gave us a little caution. And then really on that day the market broke the wedge. We were talking about 98 on Goldman. If Goldman breaks 98, how could the market ignore it? That means it's heading back down to those October lows. And if you look at Goldman Sachs, that's where we're headed. This was that area. This was that uptrend, right? Broke to the downside. Take notice. Went sideways and broke below 98. Now it's on its way. I guess it's worth a look versus this level. Perhaps we try and get a little bit of a bounce, but every time you get a little bounce, it just doesn't work out. I would say watch Bank of America, really weak. Once it broke this wedge, see, you can even time it. Like people say, oh, it's already at 650. Where's it going to go? You know what, percentage-wise, when it broke below 633, you could have saved yourself $1.20. $1.20 on a $650 stock, that's a big percentage. Okay, so you could always manage your positions. And now it's coming into the low here. If it starts to break below $5, you're going to see the psychology of the banking sector get a little bit more intense. As far as retail, it's in vogue today, or it's in the spotlight with Black Friday and then the weekend. Take a look at Walmart. We'll see what that did. It's still hovering here. If you're a longer term position in Walmart, that's fine. But if you're trading it for momentum, if Walmart starts to break below this support, you got to get out of the way. I know a lot of guys went long, in this area around 53. It became a nice macro trade. But if things change, you change with them. And right now, you have a small little wedge here. If it starts breaking above this 57, it probably would be decent for the market. Maybe you get a little momentum back to 58 or so. But if it doesn't hold this 56.32 area and you're not committed to the longer term, you could easily see this 50-day. So just watch that as a barometer. RTH is, it's hovering on this 200-day. It's hovering on bigger support. So see if it holds. The low from Wednesday was 106.27, so watch that. Below that, there's really not much support all the way down to this 102, or really major support is back at those lows from October. And if we start losing retail, which has been a bright spot, there's going to be some more trouble coming in. The Qs, which went from one of the stronger sectors to one of the weaker sectors, there's really not many points of reference here. You know, this is, I guess, like kind of correlates to where the spiders are, but maybe you get a red dog reversal, goes down, comes back up above 53.26 for a trade. This is obviously big support, which we have a lot of room between here and there. So a lot of these indices are starting to roll over or no man's land, and it's just a time for caution. There's no constructive nature. IBD has us in correction since that Wednesday, the same day the wedge broke to the downside. That means caution. That means you should be in a lot of cash. And especially with these headlines rolling in, getting worse and worse, you know, you could trade intraday a certain way, and then you hold stocks overnight a certain way, depending on your time frame and risk tolerance. For me, you know, I went on that Wednesday from getting stopped out at 10, 12 positions to back to trading for cash flow. Unfortunately, I didn't flip short that day. A lot of people were looking for, you know, people who weren't trying to anticipate which way it was going to go, saw which way it was resolving, and jumped on it. That's typically what you have to do as a trader. You don't have to anticipate which way. You just have plan A and plan B. Plan A was above 1260, plan B was below 1240, and plan B came into situation or fruition. At this point, you know, even those that I think got short there, you know, and started trying to buy and be cute Tuesday, Wednesday, are getting a little frustrated because it's like that silver trade where, remember, we all tried to be short silver, and we finally got the trade from 48 to 42, made like $6 short silver, and then tried to flip and say, oh, we just went from 49 or 50 down to 42, and then it just really never bounced. And it was like a slow trickle, and, you know, it doesn't have to do anything. That's the moral of the story, is the market does not have to bounce. But we are, well, you know, we're oversold. I think we're above 95 on the oscillator, so that's an extreme measure. But we are in an extreme environment. So if you're short, I definitely think you should cover some. If you're long, do a level versus a level. Don't get too big unless we see something clear cut, and try and make some cash flow. But overall, this market's basically broken, and you shouldn't be putting yourself at risk. And again, hopefully you had a nice Thanksgiving. There will most likely be no recap today. It's a short day. I'll be on the radio for about an hour or so. And then my parents are in town, family's in town. I think you should do the same thing. Enjoy them. The market will be here on Monday. Have a great morning. Scott Redler, T3 Live, and tune into the radio, and I will see you Monday morning.